All right. Well, thanks all and Happy New Year to everyone. It's quite a doozy already. So, but we're at Brio really excited about what 2021 holds in store for us and for our wonderful clients. And Brandon's here today to talk us through the new stimulus plan and relief. And, and of course, if you have any questions during, feel free to unmute yourself and speak up, and we'll just let Brandon take it from here to give a little overview. And then we're happy to, again, address any specific concerns or questions that you have. All right.
And I think it's a small enough group that you all just interrupt me by all means. Interrupt makes no difference to me whatsoever. The only thing I ask is that, like, as we're going through stuff, generally speaking, try and keep yourselves muted so that it's not like pure chaos, just a little chaos. And obviously, as Shannon was just mentioning, today is a very interesting day, and not just like with storming of the Capitol, but with what appears to be, Democratic control of the Senate. So it does kind of change, how we think about, some of the tax law stuff and what Biden might be able to get pushed through. So we'll talk about that a little bit too, I think. But first of all, let's start off with the stimulus 2.0, I think is probably the easiest way of talking about it. So the biggie, the one that will impact everybody, is that there's another, or not, it shouldn't impact everybody, I shouldn't say that, but the biggie is the extra $600. So much like the original plan, if you are under certain income thresholds, you essentially will get an extra $600. Now, it does get phased out just like the original did. So it's $600 per individual. And if you have kiddos that are under 17, they qualify for an extra $600. And then there's a phase out. So if you, essentially it starts at $75K for single filers, $150K for married filing joint, and then you get phase out of it. It's not like a typical phase out though. So it depends on what you were starting off with. So like a single person with 10 children, it'll take them a lot longer to get phased out than like a single person with no children, right? So in general though, like 75K for singles and 150 for married is where we start getting the reduction in that. And most people, like Shannon and I were just talking, like are already getting their stimulus checks. So if you're entitled to one, it is coming, essentially. It should be there very shortly. The IRS does have a, like, forget what they call it, like where's my check or something like that tool on the website. That you can go and look and see kind of like when it's due. It is based off of your 2019 tax return. So if if that isn't filed for some reason, or however that is, they're going off of 2019. And just know, essentially, because for a lot of people, income is changing a bunch, the last couple of years, right? Depending on if you were out of work or had a bunch of work or whatever. So just know that the stimulus payments, the $600, you kind of get the best of both worlds. So they'll base it off of your 2019, and then in 2020. So if your 2019 income was too high, but then your 2020 ends up being lower and you were supposed to get it, then you will get that credit. Conversely, if your 2019 was really high, or if let's say if they gave you money and you shouldn't have gotten it, right, then you don't have to get it back. So it really is just a credit on your 2020 tax return that they are giving you in advance. So hopefully that made sense to everybody. So that's the biggie. Then the next stuff that
Question?
it got into. Oh, yes, sorry.
So it is neither income nor credit. It's a tax dot. Yeah, not sure how to end that sentence.
So it's basically like a rebate. So the probably the most accurate way to describe it is as a rebate. So if you, so really, if you just, it should be based off of your 2020 tax return. And as long as your 20, let's say for a married couple, if your 2020 tax return was under 150K of your adjusted gross income, then you're entitled to $1,200, period. Now, they're going to use your 2019 tax return, which is probably already on file. They'll use the numbers off of that in order to go ahead and give you the $1,200. But my point is, for a lot of folks, 19 and 20 are very disparate years in terms of income levels. And so you'll get the best of both worlds in essence.
Okay, thank you.
Good? Yeah. Okay. Other questions on the stimulus rebates?
Hey, Brandon, this is Gary. I've got a quick question. So are those payments taxable?
The payment itself is not taxable, no.
Thanks.
Other questions on the payment?
Brandon,
Yeah.
this is John Hebing. What about in our situation where Abana has a 22-year-old son? What happens there?
You have to be 17 or younger.
Okay.
So he doesn't. Now, he can get it himself, right? So if you have someone, if they're not on your tax return, they probably, not always though, right? Not always. So if they're doing their own taxes, then they would get it on their own.
Okay.
Okay.
Thank you.
Other questions on the stimulus payments, just the direct $600 payments? All right, going once, going twice. I'm moving on. The next thing is the Paycheck Protection Program. So now some of you might want to zone out here for a second because this really does apply to business owners. But it's a pretty broad definition of a business owner, meaning that people who are self-employed or in the gig economy or any kind of 1099 income whatsoever, there is essentially round 2 of loans coming out to business owners. So the first round, PPP, Paycheck Protection Program number 1, and now there's Paycheck Protection Program number 2. The main thrust of these both is to just make sure that the business owners keep staff on payroll, right? That's the whole point of it. So what this round 2 did is, first of all, it said, listen, if for whatever reason you didn't get any money in round number 1, you can go back and get round number 1, okay? If you did get money from round number 1, but your revenues are down, you can get a second round, okay? And a second round meaning you can get a second loan from the Small Business Administration. And it's probably forgivable based on other things. So in general, the way that it's calculated is that you would take whatever your monthly payroll is, and again, payroll could just be like what you pay yourself, right? And so you basically take your monthly payroll, multiply it times 2.5 times, and that's the size of the loan that you could get. It is absolutely structured as a loan, but it's probably going to be forgiven. The one exception to this is the food industry and accommodation industry is specifically called out. So instead of them getting a 2.5 times monthly payroll loan, they get a 3.5 times. So there's more money for restaurants and hotels, basically, understandably, because clearly they're having a rough go at it. But for a lot of folks who do Airbnb, that's considered accommodation. So that money would be eligible for a bigger loan. And again, you can go for round two. Round two, though, in order to qualify, you do have to show a reduction in revenue of at least 25%. So that's kind of, it's a little bit harder to qualify for the round two money. The other thing that was really big in the Paycheck Protection Program portion of it was they clarified that the expenses that are paid for with Paycheck Protection Program money are not, or are deductible. So they aren't taxed, because for a while there, essentially Congress said, we'll give you this money and you can use it to pay your expenses. And then the IRS was like, yeah, but we're not going to let you write off those expenses. And so effectively the business owners were having to pay taxes on the loan money. So this round number two, they clarified. And so now those are absolutely tax deductible. So that's super good news, folks, because that was, it was freaking a lot of my business owners out. So that's good. What else? Oh, it also opened up on the Paycheck Protection Program money. It opened up what was deductible. So now it has to be at least 60% payroll expenses in order to be forgiven. But it could be up to 100% of the money could be used for payroll expenses. So that's, for most folks, that's pretty simple to do. But there's other stuff that now you can slide in there if it helps. So like HR stuff and property damage, and there's all kinds of other junk you can use to calculate that. So if any of you need help with PPP forgiveness money, let me know. Also, up to $150,000. So if your loan amount was under 150K, there is now basically just like a quickie one-page attestation saying, I followed the rules, don't audit me. And in fact, the language even said that the banks are not allowed to ask for any kind of documentation to support the forgiveness. So if you borrowed less than 150K, you're like totally free. You just sign off on it and you're good to go. Okay. I think that's the biggie. Are there other questions around protection program? I don't want to spend, I mean, there's lots of nuances, but I don't want to spend too much time because I know it doesn't impact everyone. Going once, going twice. All right. Oh, I will say just real quick, just remember, if anybody's like self-employed or has Airbnb income or any of that stuff, it does qualify and they should be, it's basically free money from the government. So you should be getting it. And if they haven't, they need to apply for it. Okay, the other thing for business owners is there is an employee retention tax credit. So again, if your revenue went down as a business owner, but you retained employees, you can now get up to $7,000 per quarter in tax credits. So that's a really big thing. It just, I don't think impacts a ton of the folks on the line from what I can tell from the names that I'm seeing. So yeah, if you want me to go deeper on that one, but mostly for business owners, it's super helpful. Okay, other things, it does impact a lot more of you. Unemployment. So unemployment got extended. Normal unemployment got extended until, so for 11 more weeks, so basically through the end of March. So end of March, and you know, realistically, I'm not sure, I don't know that the economy will be roaring back and we're all going to be like going out to eat again by the end of March, but I guess it's better than nothing. So end of March, we have unemployment extended. And we also got the extra $300 on top of regular unemployment extended. And, you know, for a lot of folks, I mean, that's quite a bit. I mean, it doesn't double the unemployment payment, but it's close to it. So that's pretty important, I think. And then also, again, for unemployed folks, because typically speaking, somebody who is self-employed, they wouldn't qualify for unemployment coverage. Like if you were driving for Uber or something like that, or just an independent contractor doing some work on your own, any of that income still will qualify for unemployment coverage if you've had a reduction in income. So it doesn't have to be all the way. So for people who are independent contractors, super flexible, and you can absolutely get some money. It's called the Pandemic Unemployment Assistance Program. So it's slightly different than regular unemployment, but it functions the same and all the rules are essentially the same. So that's a biggie for folks. Okay, what else matters? Oh, so I'm sure you can see from the look on my face, I don't love this part of the plan, but one of the things that happened last year was you had the ability to defer payroll taxes. So by and large, what you put into Social Security, right? Now you could go to your employer and say, don't withhold this money, and then you were going to have to repay it the first quarter of 2021. But the employer could do the same thing on their side of the fence and defer their payroll taxes too. Most people didn't do it. I mean, certainly anybody who came to me, I said, just whatever, it's too much of a pain in the butt to deal with, so don't worry about it. Just know that if you did do that for whatever reason, and you were supposed to pay it back in Q1 of 2021, you now have this whole year to repay those payroll taxes. So they made that a little bit easier for folks. But it's super confusing. So if any of y'all did it, yell and I'll explain further, but essentially you have more time to repay that now. Okay. On medical expenses. So for the last few years, so for most people, if you're itemizing your expenses, your medical expense deductions had to be greater than a certain percent of your income in order for you to write them off. It has vacillated between 7.5% or 10%, depending on how old you are and depending on what year it was and blah, 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 blah. They have essentially said it is now going to be 7.5% is the floor for deductibility of medical expenses. So just period, from now on, think of 7.5% as the floor on medical expense deductions, which that is, I think, good news for some clients. It doesn't impact a ton of folks, but some. Tuition. So for a while there, we had switched things over so that expenses related to tuition were deductible, but it also got phased out at really low income levels. So know that the lifetime learning credit is replacing the tuition and related expense deduction. Credits are always better than deductions, okay? Credit is, $1 of credit is equal $1 in your pocket versus $1 deduction is probably equal to 35 cents in your pocket or something like that. So we like this provision. This is a good one. It also now, the phase out range is like 80 to 90,000 for singles. And for married folks, it's 160K is when the phase out starts. So the income limit went up a fair bit on this. So for anybody who does have any kind of tuition expenses, the lifetime learning credit is a much better opportunity than we had before. And it actually aligns with the opportunity credit, which was already there. And I know everybody's like, oh, you think about kids or whatever, but I have plenty of folks who, are in their 60s or 70s or whatever, and taking classes at From or other things like that, that technically, you can qualify a lot of those things as education expenses. You take a trip to Cuba or something like that. Like, not that it's happening during the pandemic, but maybe the second half of the year, let's think. So anyhow, there are some creative ways to use that one, okay? Okay. charitable deductions. For a lot of folks, what happened with the tax bill that passed a few years ago, I typically call it the Trump tax bill because that's how most people think of it. But in general, the amount of things that were deductible kind of went down a whole bunch. But then the standard deduction went up a bunch at the same time. So a lot fewer people were itemizing. A lot of people just started taking the standard deduction because they didn't have enough itemizable deductions. So they also replaced at the same time, they said, okay, fine, we'll let you do a standard deduction, plus you can write off up to $300 per year of charitable contributions. So that's called an above the line deduction because it doesn't really matter. The rest of your deductions don't matter or not. So it's an above the line deduction for up to $300 towards charity. But that was, of course, a 2020 only provision. Now, Stimulus 2.0 changes that, and it allows up to $600 for marrieds, and it goes for this year as well. So in the past, it was just a max of 300. Now it's 300 or 600, depending if you're married, and we get to do it for 2021. But it was one of those little itty bitty things that was in the original package that most people didn't really see or understand. So just know, even if you're taking the standard deduction, you can still write off some amount of charity, okay? It also allowed us, so typically you can only write off a certain amount of your income against charitable contributions. For last year, you could do unlimited. Frankly, I probably don't want anyone to write off 100% of their income, but in theory you could. So I can't really think of anybody who's doing 100% contribution. Just know that if you're planning on doing that, I don't actually want you to do that. And we have to be a little more strategic about it, even though the law allows for it, okay? Oh, we've also done donor advised funds. We do a ton of those. So if anybody has a donor advised fund, know that charitable contributions into those are different than the rules I was just talking about. So that's kind of a whole separate ball of wax, okay? All right. Meals are now 100% deductible. Not that anyone's eating out, but in theory, if you are eating out and it's like a business expense, and again, there's plenty of ways I think where folks can end up with this, even if you're just a regular employee or even if you're retired, but if you have a little bit of self-employment income on the side, there are still ways that you can kind of slide this in there. They're now 100% deductible for whatever you might. Now, it also kind of changed the verbiage, which was kind of interesting because they said food or beverage provided by a facility. And so clearly, if you just did carry out, that's tax deductible, but it would be, for me as a business owner, that's kind of interesting how they're changing the verbiage, because like rolling forward, that kind of, does that mean like anything I don't physically make with my own two hands is now tax deductible? I don't know, it's excited.
Oh, Brandon?
Yeah, yes.
It's Philip. I have two quick questions. You're talking about 2020 tax or 2021 right now? That's the first question. The second question is regarding the charity. Is that again for 2020 up to $600 beyond or separate from the donor advisement fund?
Yes. So I am actually vacillating a little bit between 2020 and 2021. So apologies for making that so confusing. I will tell you, most everything that I'm talking about applies to both 2020 and 2021. So the general rule is they did it for 20 as like a one-time thing. And now this 2.0 version is saying, and we'll extend that into 2021 as well. So there are a few tweaks that are minor differences, but generally speaking, it's true for both years.
Okay, thanks. Thanks for
And then specifically for the charity, that is both 2020. Well, for charity, that $300 above the line deduction, it really is just $300 for 2020, regardless if you're single or married. For 2021, it's 300 single, 600 for married.
Okay, thanks for clarifying that. Thank you.
Brandon,
Yep.
question then. So for the meal deduction, would that apply to courier deliveries like DoorDash and Uber Eats and that sort of thing?
Apparently, that's, I mean, the way it was phrased, I mean, I highlighted that portion of it because it was like provided by. So yeah, in theory.
Okay.
Okay. Earned income tax credits. So this is a quirky little thing. I don't know how many people really pay attention to this because it really, so an earned income tax credit is basically a credit, which again is like dollar for dollar money in your pocket for people who don't earn a ton of money. So like for this year, it was for a single person, it's under 16,000, 15,700 or something like that is the cutoff. And for married, it's I think 22K or just a little under 22K is the cutoff. But it's earned income, right? And so if, for example, I had someone who was, they might have decent bits of taxable income, right? Because they might have Social Security, they might have pension, they might have annuity. None of that is earned income, right? Interest, dividends, none of that's earned. That's all just me sitting here and the money just shows up in my checking account. Hallelujah and amen. But for earned income, right? That could be somebody, say, for example, who is picked up a little job with the Census Bureau last year, and they made $5,000. Well, now, again, they might have 100K coming in, but 5 of that is earned income. And so they would qualify for the earned income credit. And that's a pretty nice thing to do. So just remember, for people who are like recently retired, if you had just maybe, you might make a good salary, but if you only had 1 month worth of salary and then you retired, you would qualify, right? Or vice versa. If 2020 was just one of those weird years where you got laid off for the bulk of the year or something, you might end up in an earned income credit scenario. So all that is to say, one of the changes they made in the rules is that you can use your 2019 tax return to qualify for a 2020 earned income credit, because you might have somebody who literally had no income in 2020 because the little job that they did have went bye-bye, right, amidst the pandemic. So you can use your 19 in order to get your 20 earned income credit, okay? Student loans. Okay, those of you who are younger or dealing with younger folks who have student loans, you can now have your employer pay for those up to $5,250, and it is essentially tax-free. Now, you have to have, obviously, a generous employer to do it, but there is a way to do it. And for those of you who have employers who don't do it and have student loans, you should lobby them. So in all sincerity, and the nice thing is for that 5K or 5,250, the employer doesn't have to pay payroll taxes. The employee doesn't have to pay payroll taxes. It really is almost like it's just, there's no money movement almost, according to the eyes of the IRS. So that's a pretty cool thing. They've done that now. They've extended it through 2025. So the assumption is that'll probably become a permanent benefit in the tax code, but who knows? Shannon.
All right, question then. So does the educational pursuit have to have anything to do with the job in question?
Nope. Just student loan.
Okay. And would you classify Brio as a generous employer?
Absolutely not.
Oh, that's too bad.
So, Brandon, I have a question.
Yeah.
So does the employer have to directly pay, or like our company has a program, it's called Gratify, that we go through, and it does somewhat similar to that.
Yeah.
So that counts
Yep.
for that?
Yep, that counts. So you can, so there are services, right, who essentially facilitate the student loan payment on behalf of the employer, which is awesome, right? It takes some of the handwork out. But you also, like, the employer could also just give the money directly to the employee, and the employee can make the student loan payment on their own, and that would still count.
Great.
Okay. Now, I know we had said this would only go until 1:30, so I apologize. I'm going to keep going. There's not a ton more for me to go over, but there's a little bit more. So I'm just going to keep going. Whoever needs to drop off, we love you and goodbye. Okay. If, God forbid, you had to do a short sale or foreclosure on your house, typically that debt that's forgiven counts as income to you. So you end up having to pay taxes on the forgiven debt. That does not happen, at least until the year 2025, if it's your primary residence. So hopefully none of y'all are in that boat, but that's in there. Flexible spending accounts. So for those of you who have money in your flex spend account, it could be for dependent care, or it can be for healthcare. Those typically are use it or lose it, right? If you don't spend the money by the end of the year, then it vanishes. And I don't really know where it goes because the employer doesn't get the money. It just like evaporates. I don't know. But anyhow, those can be carried forward now. So a little baby relief in that your 2020 balances can roll over to 2021. 2021 balances can roll over to 2022 even, but then it stops. So just know you have a little more latitude for 2 more years in terms of spending your flex spend account dollars, okay?
Brandon, we have a question about unemployment benefits. So will this be automatic, this, the extension and the increase, or do people need to reapply for people that received it and stopped when it recently expired?
Okay, if it's stopped, I mean, if your payments have stopped, you need to reapply. But if yours kept going, then it'll continue going.
Okay.
So basically, it sounds like for that particular person that they will have to reapply, as annoying as that is. Yeah. Okay. I mean, there's a couple like smaller things that are included in this. Private mortgage insurance, if anybody's paying that, those are still going to be tax deductible. Solar and fuel cell vehicles, there's another year of extension on those. Those were set to expire at the end of 2020, but we've got credits going in 2021 on those. On FAFSA. So this is another quirky thing they threw in there. So anybody doing the financial aid application, there's major changes coming to that in 23. So FAFSA is changing a whole bunch. Now that's what's in there. Those are the biggies of what's in the bill. It's literally a 5,300 page bill. So there's all kinds of random stuff, but those are the biggies. What's not in there, which we've been getting a bunch of questions about, is required minimum distributions are set to resume in 2021. So there were no required distributions in 2020, 2021, they're back. And then student loans, so those were kind of put on pause, that there, it was federally backed, federally backed student loans had a 0% interest rate, and the payments were suspended up until the end of January. It kind of got pushed back a couple different times, but basically student loans, you don't have to pay those through January 31st of 2021, but they're set to resume after that. So no additional student loan relief. Sorry. And then the RMDs, there was a lot of confusion for people who had taken money out of their IRAs and wanted to put it back in and didn't, and blah, blah, blah. There's no additional relief there either. So either you got the money back in time or you didn't, and that's over. So that is the big stuff on the Stimulus 2.0. Questions on any of that? Okay, I'm going to talk for 4 seconds on Georgia. So, Your timing, 4 seconds, I talk fast. Okay, so it's looking pretty darn clear that you have 50 Democrats and 50 Republicans in the Senate. And so our dear friend Kamala Harris will be the deciding vote there. So all of a sudden, you probably have a whole lot more ability for Biden to get some of his policy changes enacted. Now, clearly, we have some very thin majorities here. You can't have a single defector. So Biden just doesn't get to get all of his stuff implemented on day one for sure. But it's a whole lot different than it looked 2 months ago, right? When it seemed like we had kind of that check and balance in place. So I just want to go over a couple of the highlights, at least of the Biden tax plan, to make sure people are kind of aware of what's going on there. Because we've had a bunch of questions of that over time, and it seemed like, oh, well, it's probably not really going to matter, but now all of a sudden I think it might matter again. So Biden tax proposals, what really happens, who knows? But the important stuff was, if you make over $400,000, the tax rate goes back up to 39.6%. They've never said if that was for a single person or for a married person. So, it'll be interesting to see how that really shakes out. But for those earning over 400, taxes are probably going to go up. For business owners, and again, you can be a self-employed business owner, like a one-person shop, right? Qualified business income deduction. So for the first time ever, a few years ago, they installed a deduction for earning money. Like, historically, you've always had to spend money to get a tax deduction. This thing was just like, if you make money, we'll give you a tax deduction, which was quite interesting from a tax policy perspective. So at any rate, the qualified business income deduction would also get limited to those only making under 400K. So essentially, if you make over 400, too bad. Something that has been proposed that is to me, is a really big deal is any contributions to IRAs, traditional IRAs, and traditional 401ks have always just been deductions against your ordinary income. Biden has proposed replacing those tax deductions with a flat tax credit. Now, again, credits are better than deductions. However, deductions also benefit. The more money you make, the more benefit you get. So somebody who's in the 39.6 tax bracket gets to write off $10,000 versus somebody who's in the 20% tax bracket getting to write off $10,000. Those don't have the same impact. So that credit is a way of helping to equalize the benefit of retirement contributions. Okay. Now, my job is, of course, to game the system however I can to help my clients. Sorry, that's just the way it works. I don't make the rules, I play the game to your benefit. So the benefit to you all is probably, more than anything else, going to be Roth. And I'm sure most of anybody who has ever shared more than 4 seconds with me has heard me complain, advocate the Roth. So I'm going to be advocating Roth even more in the future. Heads up.
I don't know if that's actually possible.
All right. If you make more than $1 million, first of all, God love you. And secondly, your capital gains will probably switch. Instead of having a flat 20%, it'll probably switch to an ordinary income rate on cap gains over $1 million. Okay, which is kind of a big deal. That's really doubling. So it would go from 20% to 39.6%, and then there's all the other tax on top of it. So cap gains could look very different for people in the higher brackets. Also, he's proposing that estate taxes change quite a bit. So as it is right now, when someone passes away, their heirs get a step up in cost basis to the date of death valuation. But what would happen under the Biden proposal is effectively that asset would be sold from a tax perspective, such that the value of it at death, the heirs would have to pay the taxes on that amount. So he might be increasing the cap gains tax and eliminating the step up in cost basis such that it would almost force the sale of the asset for the heirs. Or it would, I mean, they wouldn't have to sell the asset, but from a tax angle, it would look like they would. So, you know, they'd have to come up with the cash to pay for it. And so in many cases, it might force the actual sale of the asset, especially if you have illiquid farmland or something like that. Likewise, the valuation at which point the estate tax kicks in is also going to come back down. You know, he's advocating somewhere between 3.5 million and 5 million. That's a whole lot lower than what it currently is. Currently, it's over 11 million, and it's double if you're married. So it could easily start getting into the, you know, the quote normal San Francisco household, right, where you own a house and have some money to your name, and all of a sudden you have to pay estate tax. So heads up there. And then the last thing is one that also impacts San Franciscans a ton, which is the SALT cap will likely go away. So SALT, state and local taxes, historically, we've been able to write those off for any amount. So whatever you pay to the federal government, I mean, whatever you paid to the state, you could write off on your federal tax return. And whatever you paid in property taxes, you could write off on your federal tax return. But the Trump tax bill said, listen, we're taking the combination of those two and limiting it to $10,000. So that's the SALT cap at 10K. Biden will probably get rid of that. Now, that was a giant, you know, FU to all the blue states, California, New York, and New Jersey, who have high property taxes and high income taxes. So, you know, on one hand, people are hearing, oh, I make over 400, my taxes are going up. That is probably true under, you know, Biden and Democrat controlled Congress. But at the same time, there are other things that will come into play that will offset that. And for a lot of our clients, that offset is even greater than the additional tax hit. So it will easily balance each other out, if not allow you to come out ahead, especially if you have, you know, decent property taxes or state taxes. So those are the big things on the docket out of California. Yes.
Brandon, quick question. So I'm assuming this is 2021 that this could take effect, correct? Not 2020.
Correct.
Yeah.
Yeah,
Okay.
it will for sure not be 2020. Yeah,
Right.
Any of the Biden tax stuff would be 2021
Right.
at the earliest.
Thanks. Okay, thanks.
Yeah. Other questions?
Okay, well, speaking of property taxes, next week, Brandon will be hosting yet another call about the implications of Proposition 19 to California property taxes. And that's same day at noon, next week, the 13th.
Oh, I already paid my property tax. Am I going to get a refund now?
You have to tune in next week, Philip.
I will, for sure. I'll be there. I'll be there.
Okay, y'all. If there are any other questions, I'll let you go because I know I talk longer than I was supposed to anyhow. But there are a bunch of different things in here, and I know it feels like stuff changes every single year anymore when it comes to tax code. So just make sure you're yelling at us with your individual questions, okay? Or if there's anybody you know that might be impacted by any of it, just have them give us a call. Okay.
Thank you.